You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. This is Financial Survival Network. I'm your host, Kerry Lutz. And, well, gold. Have you watched gold? Have you watched silver? Gold over $2,700 an ounce. Silver over $34 an ounce today before pulling back a little bit. And by the way, this is October 21st of 2024. Bob Hoye is with us now, the master of economic history, who can read the future by simply looking at the past. Bob, it's great to have you back on. So what is happening now?
Okay, good to be with you and with our listeners. And thanks very much for the rave review. I'm going to try hard to live up to it. Yeah, check the action in silver. Getting a little overbought in the weekly, but the rise is not over. It might run into resistance in the next month or so. And while there is some resistance in the chart there, it's getting overbought, but not enough to make a call to change anybody's position. So, and it's a good benchmark for the whole precious metal sector, gold and gold and silver stocks as well. So, I'm enjoying the rally and content with the gains, and looking on this move for a little more yet.
So how much higher?
Yep.
How much higher can it go?
Yep. Oh, I haven't put it. Well, as I said, on silver, it's at a zone of resistance, this 35 level, but what we look at it from a historical view, and also to put the history together, Kerry, you have to deflate the price of gold. Of course, it's been inflated years ago by the Consumer Price Index, or we call it the rate of inflation. Because in England's long history as a senior economy, there was a long period when gold was convertible into, or the currency was convertible into a fixed amount of gold, i.e. a gold standard. But within this, the real price of gold fluctuates. And the old story about taking a guinea to buy a men's suit, that can vary all over the place. So what happens with gold deflated is that it downticks going into a great financial bubble. And, of course, the last big high for gold and silver was in 2011. I mean, that was a spectacular blow-off. But then as the post-bubble contraction comes in, gold's real price has turned up, and it has. And I've got a chart showing this turning point on the bubbles, 1929, 1873, 1825, 1772, and all the way back to 1720. So it's a consistent pattern, and it leads to overall a 20-year bull market, whereby gold's real price goes up. Now, Kerry, we found a year ago in June, we found a more vivid way of looking at it. I took price of gold and divided it by the CRB commodity index, then suggested that the CRB commodity index is actually a proxy for the cost of mining. So if the CRB is going down relative to the bullion price, their profit margins are going up. And it has nothing to do with the dollar, with the DX. Now, all the gold and silver bugs out there all get excited. Mm-hmm. And in their mind, the only way the game will work is the dollar's going to crash. Well, here's another one from history. I got 4 items that are key to tracking the transition from a great financial mania to a depression. And one of them is gold's price going down a little as the bubble finished, then going up. Got that one. The other one is that copper goes up with the bubble and then goes down. And that one was working. And then the other is real long interest rate, like for the 10-year. It goes up. And then, of course, the fourth item is the U.S. dollar becomes, the senior currency becomes chronically firm. And I think I can give an explanation of why this happens. It's because during the financial bubble, everybody around the world goes to New York, the world's financial center, and borrows money. And then when the bubble's over, the pressures are that you pay the money back. So everybody out there is selling something. The other guy's currency or selling copper or whatever they produce in order to get their hands on dollars in order to service obligations in New York, was the financial capital. A long time ago, it was the British pound and London, when London was the financial capital. So this has been around for a long time. And so I really like working with the gold divided by the CRB. And it is up at, as you would expect, at new highs. Not overbought, but this is now, I think, eight months of rising. So on this schematic, all gold miners, their profit margin should be improved roughly through this business of gold bullion price outperforming the cost of mining. And this is a very practical way of looking at it rather than getting all excited about the evils of the Fed and the dollar's going to go to zero. Well, there's a whole lot of currencies out there that are going to go to zero before the U.S. dollar does. And as I say, strength in the senior currency can be described as being due to the just servicing debt obligations in New York. Take a look at Argentina. They're always complaining about the strong dollar, but they owe huge dollars in due and payable into New York. And then the great Thomas Gresham, in 1550, he was the financial agent for England in the money market in Antwerp. That was then the commercial and financial center of the world. And in his letters, he points out to the crown how difficult it is in meeting debt obligations from a weak currency to the strong senior currency. So there's lots of letters about that, and which I've enjoyed reading. I've got a book on Gresham, so, and then there's many sources on Gresham. So,
what about?
And of course, there's Gresham's law, which is bad money forces out good money. He wrote something pretty close to that, but hey, I'll give him credit for it. He got it. He nailed it. And the problem is servicing debt from a weak to a strong senior currency. So this is what the world is going to be facing with over the next couple of decades. So, and this is we're long time bullish on gold's real price. So with the real price going up, my producers, their profit margins will be enhanced, and then even that then puts a better valuation on mineral, exploration bets, and it's just the way it works. So,
so rumor of the dollar's demise have been greatly exaggerated, huh?
Yeah, it's not. Let's put it this way: approximating a good move for gold based upon a falling dollar is a speculation in foreign exchange fluctuations. But if you go with the idea that with commodity prices being weak, their profit margins are improving, and therefore their cash flows are improving. So then when you're buying the gold sector based upon a stream of increasing earnings, that's investing. And I can see it with if the big stock market gets bad, and I believe it will, and then you've got ordinary fund managers, equity fund managers, who wouldn't touch the golds with a 10-foot pole. But if you get a couple of quarters where the GDX is outperforming the S&P, those guys looking for performance will have to buy the golds. So I'm very bullish on gold stocks. We're early years in a multi-year bull market for the gold.
Okay.
The 1930s, my God, you had gold stocks going to the moon. Dome mines, that sort of stuff. Placer, Placer started at 1922. And then if you go back to previous depressions, there was always the real price went up, and then eventually there was many unemployed in commercial areas around the world, and the real price was high. So then you had your great mobile gold rushes at the worst of a depression.
Mm-hmm. Understood. And
so
to be expected.
1849, the California gold rush. The depression bottom was 1844, 1845.
Mm-hmm.
And then the 1897 gold rush up and the Klondike, that was the Great Depression ended at 1895.
Right. Gotcha. So what more can we look forward to here, Bob?
In the stock market, it's possible. It's not yet overbought, but when it finally gets there and rolls over, we'll be going into a bear market. On the bond side, even treasuries are vulnerable, mainly to a liquidity crisis. So for fixed income people, we say, take a look at the 3 to 4 year good grade U.S. corporate bonds. You'll get it, because if you go short term, like T-bills or various deposit things, the yield's going to head towards zero. But if you're in a 3-year good grade corporate bond, you're getting a decent yield, and the price won't whipsaw you, because it's going to be maturing at par 3 years or 4 years hence. So that's kind of a nice investment world. I mean, even equity people, rather than being long equities and vulnerable there, would consider parking in 3 to 4 year good grade corporate.
Okay. All right. So you have a list of stocks that you expect to perform well. So how well has it performed so far this year, Bob?
Our list of gold juniors, there's been a couple of turkeys that have done nothing out of a list. I think it was 11. And but on average, they're up 10% since Christmas. And so, but the point of going at gold juniors, when it really takes off, these things have the potential of making big moves. I mean, you can buy and leverage up on them, but that's good. Whereas if you buy a suite of junior golds, the downside is not much, and in some cases the upside could be rather good if somebody may. Well, the sector will do well in a rising market for general gold shares, because at a bear market they get overlooked. Because when you come out, you get the senior gold stocks outperforming first, then the middling sized ones, and then finally the juniors get tagged up. And so the percent gains in these things can be rather good as the bull market continues. And then you also have the possibility that one of them could come up with a discovery, in which case you've got a global phenomenon. Way back when, 1996, I made a list of 5 junior golds. And one of them was Iroquois, and it went to $30. It was taken over by somebody for a $1.1 billion market cap.
Wow.
So gold juniors can do very well.
All right. Well, always interesting speaking with you there. Yeah. And
people could inquire about the list, and we'd be glad to send it.
All right. And actually, we're going to put a link to your list in the show notes to this interview on financialsurvivalnetwork.com. If you got a question for Bob or myself, shoot me an email right away to kl@kerrylutz.com. We'll get your question answered quickly. And hey, while you're at the site, please sign up for your free newsletter. Bob, it's always amazing talking to you. Be well and stay dry. I hear you got like major flooding up north there. So stay dry.
We had some rain, but the storm has quit now. And great to talk, Kerry. Look forward to it anytime.
Yeah, we've been having our share of rain here too in Florida, so we can totally empathize with you. We'll talk to you again in a month or two and see where this mess leads us next.
Good deal.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.